Hello and welcome to our BlackPoint Capital Partners market recap for April 2025 with Arun Kaul. Today's agenda will be a background on Arun Kaul himself, Liberation Day, US dollar reserve currency, a rate outlook for both the short and the long end, credit spreads, the S&P 500 risk premium and earnings outlook, some portfolio considerations, and at the end, some questions and answers. A little bit about Arun. He's a chief investment officer here at BlackPoint Capital Partners, and he brings nearly 30 years of investment management experience across equities, fixed income, alternatives, and hedging strategies to the firm. He's a former CIO and chief strategist at a $4 billion bank-owned advisory firm and president and CIO at a $2 billion management consultancy. He has led investment strategy and portfolio construction for institutions, family offices, and high net worth individuals, and he oversees BlackPoint Capital Partners model portfolios, tactical strategies, and investment committee process.
All right. Thank you, Nico and Daniel. Nice to be with everyone today and welcome. So what we'll do to start is we'll give a little bit of background on some of the current events, in particular, the administration's Liberation Day and the tariffs announced by the administration, some of the feedback we've seen, some of the response we've seen to that, and then try and address some of the other issues besides just the economic issues that the administration is attempting to address. So from a purely economic perspective, tariffs are a tax, like a sales tax or an income tax or a property tax. So generally, it will lead to higher prices for those goods and or potentially less goods available, in the sense that once you tax goods, we end up with lower production of those goods. So the U.S. is attempting to also address other issues, specifically reshoring and trying to have the U.S. be a larger center for manufacturing, in particular, some of the lower or medium end manufacturing around certain products and certain hard goods. And there's definitely an element of national security concerns where the U.S. does not manufacture certain areas such as rare earths, which are meant for AI and for potentially robotics, and steel and aluminum, which are big inputs into automobiles, but in particular military as well, tanks, missiles, and jets. So there is some concern that the U.S. is exposed in some of these supply chains for critical goods that are considered important to national security. So there definitely are different layers of goals that the administration is trying to achieve with their tariff policy. Unfortunately, in part, the way the tariffs have been addressed make it very difficult for certain industries or certain consumers to navigate through some of the impacts, specifically the high level that's been applied to China, which is now 145%. The risk here is that once the tariffs get so high, it just immediately stops or ceases certain industries to operate or certain orders to go through. So we have seen some cancellation of some orders through China for certain products, given the change in price. So the concern here is that if we have industries cancel orders, we get a fairly quick knock-on effect wherein we have a shortage of inventory or shortage of supplies, or consumers and producers have to both make significant changes to their operations in order to acquire some of those products. So there's definitely multiple layers that are at play with these tariffs and with the goals of the administration. A lot of the economic comments that you hear on Wall Street or through strategists don't really talk about the other concerns around strategy, national security, or specifically manufacturing or rebuilding some of the manufacturing. But they're definitely a goal for this administration and one of the focal points that they ran on that they're attempting to address.
Thank you, Arun. And just one question on that there. A lot of economists and people online are saying that these tariffs were potentially, and especially the rollback, were mismanaged in a way. Would you agree with that? And do you see that as potentially bringing any more volatility to the markets or the economy as a whole?
So unfortunately, I think there's some truth that they were not managed as well as they could have been, or they were mismanaged, or there were certainly other ways to implement what the administration was looking to do. And it does cause volatility simply because it drives certain levels of insecurity or or unknowns in terms of what the policy will be. So it makes it very difficult from a planning perspective for corporations to say, okay, we can plan for this in terms of manufacturing or producing a good in a certain country. If you just give firms 4 weeks or 8 weeks or 12 weeks or 16 weeks to adjust, they're all able to adjust. But moving a supply chain overnight out of China or into Vietnam or into Cambodia is very difficult to do. So in the short term, it definitely creates instability and higher levels of uncertainty if we see some order cancellations. The key thing here, and this we'll talk about this on the investment side, is we now want to look much more closely at balance sheets, specifically corporate balance sheets and even investor balance sheets in terms of strong cash flows and maybe some more defensive or risk-averse positioning.
Perfect. Thank you, Arun.
So the other issue, and this is a long-term issue, it's definitely a more complicated issue, but the other issue the U.S. is attempting to address, the administration is attempting to address, is that the U.S. as a reserve currency is always in demand. And the key here is that the demand is inelastic, meaning it's not sensitive to price. So many countries demand or purchase U.S. dollars in part to manage their economies, or in some parts to control capital flows out of their country, or to assist specifically in subsidies and the manufacturing of product out of their country. China is a big manipulator of currency and has very strong capital controls that restrict the flow of capital into and out of China. So the net result is that you have a US dollar that ends up being much more expensive vis-a-vis many countries, specifically Brazil, India, a lot of South American countries, even Asian countries like Vietnam and the Philippines and Taiwan and Indonesia. If you go back to the late 1990s when the Asian currency crisis occurred, many of these currencies are 30, 40, 50, or 60 or 70% cheaper or less value today than they were against the US dollar over the last 10 or 15 or 20 years. So the cumulative effect of all of this is that the US dollar, as it becomes more expensive, is most punitive to manufacturers and producers of goods in the United States that are lower margin or lower value add or more commoditized producers. And in part, because of that, the more expensive production costs in the US, we've seen job losses in certain industrial and manufacturing areas. And in part, the administration is attempting to address this issue.
Understand it.
Long-term issue.
And just a couple of questions on just the US dollar and currencies as a whole, Arun. Given the fact that a lot of clients' portfolios are currently in sterling or euros or other currencies, how do you see that potentially playing out over the next maybe 12 to 24 months when it comes to currency hedging potentially?
So we've generally seen a period of strength of the US dollar over the last several years, in particular against emerging markets, and also some strength against the developed markets. So with the current backdrop, we potentially have an environment where we might see dollars being distributed to some other countries or potentially placed in other countries as a hedge or kind of a risk offset against US policy if there's a high enough level of uncertainty. So we like the idea of potentially starting to reallocate some portfolios to non-US areas. Again, this is just at the margin. It's not a significant change, but we think it makes sense to start looking at some non-US markets, in part because of valuations, in part because of the current policy, and in part because of the opportunity that we see in some of these markets going forward.
Thank you. And outside of that, you also mentioned commodities. So gold obviously comes to mind for a lot of people, but any thoughts on that and how this potentially might affect some of those positions?
Yeah, that's a good question. So gold generally is seen as an offset either in periods of uncertainty or in periods of higher inflation. Now, we have a couple of issues that are underlying this as well, which is a pull for certain countries like BRIC countries to try and be less reliant on the US dollar. For the US, obviously, to use tariffs to try and punish other countries as they move away from the dollar or to try and reset the manufacturing footprint away from China. And obviously, the tariffs hit both friend and foe from a US perspective in terms of allies and non-allies. So gold in particular, in our opinion, is a good place to be even today to offset some of the risk we're seeing in equity markets and in fixed income markets, and potentially some of the risk we might see in currency markets. So gold has been quite strong. There's definitely some central banks as well that have been buyers to try and help them manage some of their local economy issues and to manage capital controls if they have capital controls in place. So gold, separate from other manufacturing commodities, seems to be still quite attractive from our opinion.
And I guess so. Just one last question on gold, right? So I know we have an allocation, maybe about 5% allocation towards gold in our portfolios. For those clients that maybe don't have exposure to gold or want to potentially increase their exposure to gold, is right now the right time, given the fact that gold is at all-time highs?
Yeah, I think clients can still consider adding to gold and look at it specifically as a hedge to some of the market risks that we're seeing currently, that we've seen the last couple of weeks in both stocks and bonds in the United States and globally. Gold held up fairly well, and in this environment is a good diversifier, and historically has always been a good diversifier against equities and bonds. And certainly when you get into environments where gold is strong, they tend to be longer multi-year periods. So you can make an argument that it still makes sense to allocate to gold even today if some clients don't have gold.
Great. Thank you, Arun.
All right, so let's move to just quickly touch on some of the markets on the short end. What the prediction or some of the forecasts now see potentially 3 or 4 or maybe 5 rate cuts on the US. Currently rates are 4.25 to 4.5. That's the target rate of the Federal Reserve. There's a 70 to 90% probability of cuts in June and July when the Fed meets. That would be 25 to 50 basis points lower. So we think we'll see some cuts on the short end. Also, the most recent inflation data was more positive from both the CPI and the PPI in the last month, which is good. However, the tariffs do push through price increases. So we're going to have a little bit of a tug and tug and flow between what we see from potentially price increases from tariffs and what we're seeing today from some abatement in some of the inflation pressures.
Okay, and I guess just one question on that there. Given the Fed is very data dependent at the moment and all of the monthly kind of CPI prints are very watched closely by everybody. If the Fed doesn't cut that 3 to 5 times over the next few months, does that impact the equity markets or the fixed income markets at all? And how do you see that potentially playing out?
So I think that the Fed and the markets are now all in the same boat in terms of either data dependent or headline dependent, depending what the administration says are the next set of policies. So the market obviously has much more room to maneuver and can move very quickly based on changes in headline, changes in policy, and changes in guidelines from the administration. The Federal Reserve has to ensure that they hit their targets. They're going to need a few more months of evidence to show that inflation is moving back towards their target, and that's by month. So on a monthly basis, we're talking 0.1, 0.2 to 0.3 points of inflation per month to get back to their 2% target guideline. So they will indicate what they're thinking, I think, in June and July by starting to do some cuts and then wait to see how the policy and how the economy overall plays out.
Perfect. Thank you.
Now, on the long end, the Fed does not control the long end of the curve. And this is where we saw some of the stress last week was that we did these slides, I think, only a couple of days ago, and the market hit 4.5 on the 10-year last week on Wednesday or Thursday and has now come back to the 4.3 to 4.4 range. So we've certainly seen shorter term volatility in the long end of the curve. But if you look at the pattern over the last 2 years, it's been generally around 4.1 to 4.2%. We've certainly seen moves up and down that were comparable to what we saw last week. So we're not quite as concerned or overreacting as we saw some of the strategists last week to the moves that we saw. And it's not clear if some of that was deleveraging by hedge funds or banks and or some selling by other countries or central banks or other drivers. So for now, we're looking at a rate around 4 to 4.25 to 4.5. And assuming inflation is 2 to 2.5, that's about 200 points of real return, which is in line with the historic average for the 10-year in the United States.
Okay, and you do see this as in line. It's not out of the ordinary with some of these bigger shifts that we've seen, as you just mentioned when we put this together. The rates were at 4.1, we're now at 4.5. Is that relatively normal? Is there anything to be potentially concerned about with some of those bigger shifts in the yields?
So I think over the short term, the answer is no. If you look at the chart, you do see some pretty significant movements. If you look at the most recent points, which are a little higher than we're on the chart, they're not out of line for past movements. And the 10-year can move by 30, 40, 50 points in fairly short order based on new information or economic releases or headlines. So it is something that we're monitoring. And I would just say that related to that are the relationship between credit spreads or corporate bonds and the 10-year treasury as the risk-free rate. So importantly, what we see here, there's 3 lines showing you the difference in the rates between corporate bonds and the treasury, which we call the spread. The light blue line is the highest quality investment grade bonds. The dark blue line is mid-range quality for investment grade bonds. And the green line are non-investment grade bonds, sometimes called high yield bonds, which are definitely a lower credit quality than investment grade bonds. And you'll see these are well in line with their historical averages. In fact, we were at all-time lows for investment grade and high yield bonds. High yield bonds have moved higher, more so than investment grade, but they are not at stress levels yet, and they're not at reset levels that indicate that we're in a recession.
Okay, and so just to kind of dive in onto that point, because obviously here in media nowadays, the recessionary fears are at all-time highs. Could you maybe dive into that a little bit more there, Arun? So you're saying at this point that credit spreads are not indicating any recessionary, any of those bright red indicators at this point?
Right. So we would look at spreads at past recessions. So let's say 2000 as an example. They reached as high as 1,000 points higher than the 10-year treasury. And in 2008, which was definitely an extreme situation, they were much higher. COVID, they were around 900 basis points. Today, we're at approximately 400 basis points, lower than stress periods in 2014 and 15 when we did not have a recession, and lower than periods in 2011 when we again did not have a recession, but certainly had stress in Europe and Greece at that point in time. And in 1998, when again we had stress in the Asian markets, but did not have a recession in the US. So for now, we're below all those points. We are looking at high yield as one of the first areas that would indicate if we're going to see concerns because the weaker balance sheets will do worse at a faster pace. And we're also looking at bank loans, of which we have lots of research and indicate market information on for smaller firms, bank loans for smaller mid-sized firms, as indicators we're looking at to see if there's further stress in these markets.
Great, thank you.
All right, then just moving on to earnings for the S&P. Currently, pre-Liberation Day and pre-administration announcing the new tariffs, the market was expecting 11% growth, 14% growth in earnings in 2000 and the next year, 2026, and 11% in this year in 2025. So the Q1 forecast is around 7%. So for now, that's what we're seeing prior to the administration's announcements last week. So we're currently in earnings season, just starting this week. The banks were last Friday. Key will be understanding what the companies are saying in terms of guidance. and what they're seeing in terms of their order books. In particular, seeing any near-term cancellations or any kind of change in demand. So it's very much sensitive now to what the forecasts are from the executives and how some of these issues play out going forward. So this is another area that we're looking at to see if we see any cuts in expectations for earnings. If we do, that will put some pressure on the markets in terms of valuations and in terms of earnings growth going forward. Again, we do expect a fair amount of volatility in the next quarter or two as some of these issues are sorted out. We do think that the administration will announce agreements with specific countries in the next 1, 2, 3, or 4 weeks, or at least preliminary announcements that will allow corporations to say that certain countries will have their rules reset and they will be able to plan accordingly in terms of where they want to allocate capital and how they want to manage supply chains.
Great. And so just to understand that, from what I'm hearing, Arun, is at this point going into earnings season, essentially we do see a tariff having an impact on some of the guidance calls and guidance that we're seeing moving forward. However, once some of these deals are potentially ironed out with the current administration and whatever country that might be, do you see that as potentially opportunities over the next few months to potentially for clients who have cash sitting on the sidelines to kind of enter back into the markets, given some of these potential outlooks here?
Definitely, because these are very significant changes in policy. So if the headlines come out and are very positive or create a significant degree of certainty as to what the rules will be, or even better, if we actually reduce tariffs on both sides, those are very positive outcomes that are potential in the current scenario.
Great. And just one more question on that there. From a consensus perspective, then, with that kind of that's rosy outlook on that side, from the clients that do have that cash sitting on the sidelines, what would be the best way to approach that? Is that maybe investing dollar cost averaging in over the next maybe quarter or so? Or are there kind of certain things that we need to be kind of on the lookout for there?
Yeah, that's an important question. I think that we're in an environment where we will get a little more back and forth. We'll get some good news, we'll get some bad news, we'll get some disruptions, we'll get some very positive announcements like we saw today from NVIDIA with a very substantial investment in the United States in manufacturing. Those are very meaningful announcements. They're a little bit longer term in terms of the benefits. And let me just add, that's one point that we haven't touched on, is that majority of what the administration is doing is very positive for long-term growth. However, the negatives, which are the tariffs, are much more impactful in the short term and need to be navigated too. So there's a little bit of a time mismatch between the negative impacts of tariffs and the longer term benefits of resetting some of the rules and policies of global trade. So the answer for clients is yes for dollar cost averaging and
Okay.
to buy in particular when they see periods of stress, especially if they have cash, as long as we get some progress on policies and resetting trade alliances with certain countries. I think you're going to see the countries like the UK, Japan, Canada, Mexico, those ones that are the largest partners with the US, be the ones that set deals first and probably the fastest.
Perfect. Thank you.
All right, and then just the risk premium. So the short-term rates, certainly the risk premium is just the risk level or the compensation for investing in stocks versus cash and or bonds in terms of clients from an asset allocation perspective. And we had about a 21% correction in the S&P from peak to trough, so from the highest point to its lowest point last week. The market still is above average in terms of risk premium versus its historic average, but it's much better price than it was at the beginning of this year. So if we get some sideways behavior, which we may, and we get some further clarity on earnings and 10-year stays around where it is now, 4%, and we get some cuts in the federal funds rate, which we think we will get, then the risk premium is much better positioned vis-a-vis the other assets for equities. So those are some of the issues that we're looking at when we allocate capital to client accounts in terms of managing some of the risks that we see in the current market.
Great. Thank you.
And then just portfolio reallocation, a couple of large questions, like the two graphs on the right. The top one shows the relative performance of growth in the US, large cap growth against large cap value. And over the last 10 to 11 periods, growth has been dominant. And the bottom graph on the right-hand side is the S&P against EFI, against the developed markets, international markets. And you can see, again, the US has been dominant for the last 10 to 11 years, more so US versus international than US growth versus US value, because there have been a couple of dips along the way in that. So part of the concern for some clients is to potentially think about rebalancing. The majority of clients have made tremendous money in growth and US names. And so this is an area that we're looking at very closely as well in terms of opportunity to rebalance after a very long run by both US stocks and growth stocks.
Great. And so Arun, just to understand that a little bit more for the clients listening in. So I think what you've mentioned there is potentially looking at reallocating some of those client assets from the US towards international growth towards value. Given the fact that the markets have taken a pretty large dip over the past few weeks, at what point does that make sense to rebalance? But or is it just more of, hey, this is a watch list for the next few weeks slash quarters as we continue to go into the rest of the year?
So I would say it's definitely on the watch list today. So it's certainly an active part of our watch list right now in terms of other countries to diversify to or to allocate some capital to, especially for those clients that are underweight international markets and have been overweight US markets. So that's something we're keeping a very close eye on. Within the US, value and growth, the big driver still is future growth expectations.
Mhm.
And if you look at the dominant firms in the US in terms of Apple and Microsoft and Google and Meta, they're still very strong in their specific markets. So they're still very good companies with very strong balance sheets, with very little debt, and with strong moats around their business. So they haven't specifically been weakened in terms of their underlying fundamentals. Going forward, we think some of the growth areas are in robotics, AI, which is a big part of the administration's push to get more manufacturing of chips in the United States, which is still beneficial for many of these countries to have a more secure supply chain, even if there might be slightly higher costs associated with that. So it's going forward, we're looking at areas like robotics, AI, as well as potentially areas of medical technology and genetics, and certainly then energy storage and batteries. So we think some of those are the key drivers of growth going forward. And we're still seeing many firms in the US that are strong in those areas. And what we're looking to do now is see international markets like Europe in particular, how they have, or which of those firms will be stronger in robotics and AI, energy distribution or storage in the next 5 to 10 years. And that would certainly be a reason to allocate more to those markets if we see some firms in those areas that are strong in those particular sectors.
Great. No, I think that makes a lot of sense, Arun. And so that's something that we will be looking at moving forward. But I think everybody just wants to understand, when's the right time? And that's always the big question. So go ahead, Arun.
Yeah, I was going to say that's a very important point. So that's why we like to recommend allocating or reallocating on a regular basis, and always to be active in the sense of making what might seem like smaller moves, but moves we think are in the right direction. So timing is, there's never a perfect answer for timing. We just want to make sure that we are in the right direction of travel, and that's what's most important. So as we see some of these new growth opportunities, if they arise in Europe, then we're going to start to move in that direction. If they're in emerging markets, which they could be, if it's more commodity or gold-based, then we'll move in that direction. So I think we're at a point now where it makes sense to start some of those allocations, but we don't feel it's necessary to overreact or to make any decisions in haste.
Yeah, great. And I think that's just a great kind of final point there when it comes to overreact. Everybody always tends to overreact in
Mhm.
these some of these instances. But from your view, it sounds as though there should be some considerations moving forward in regards to kind of what's going on in the markets. But again, never to kind of go to cash and cash in that instance.
Absolutely. And that's the key to good portfolio design. So having exposure to bonds, in particular, short duration bonds have done extremely well the last couple of months. They've been very much unimpacted by everything that's gone on. So longer duration bonds, a little bit more. Short duration bonds, very stable. Obviously, some small cash or bank loan allocations have been quite stable as well. And then there's equities. Gold, as we touched on earlier, which is a very good diversifier. So that balanced portfolio with multiple assets is really the key to navigating through shorter term market turbulence.
Great, great. And so you also mentioned bonds there. So typically when people think bonds, they think income. For clients right now that who have maybe been holding a good amount of cash or have been invested in CDs or treasuries that have been paying out a good amount of interest over the past 12 to 18 months, given the fact that we saw earlier that we're expecting maybe 3 to 5 rate cuts this year, what are other ways that clients can start to potentially look at reallocating their portfolio to pick up some income, given that they might be in retirement or are a little
Right.
bit kind of more on the conservative side?
Yeah, it's an important question. So cash went as high as 5% and was very close to 5% and was a very competitive return against other assets. So now as cash works its way back down towards below 4 to 3 to 3.5, it's not as competitive. So clients want to make sure they move into bonds that have higher yields and other asset classes. So certainly bonds is one, potentially preferred, which is in between bonds and stocks on the capital structure, can offer higher returns and is a safe investment. The other area that we like as well are some assets that are hard assets that have reasonable cash flow, so infrastructure and pipelines are other areas that we think will do well, that are both a diversifier as well as an offset to inflation and can pay higher yields than we see from cash.
Great, great. No, I think that's some great considerations there, Arun. And just a couple more questions. I know we're getting to the end of the time here, but again, just given the fact that there have been a lot of potential policy shifts and changes in the market, what would you say is maybe kind of your base case for best case scenario over the next 12 to 18 months, and maybe some of the worst case scenario? Could you give us a little bit more insight there?
Yeah, so best case scenario is that we have a fairly fast resolution to many of these tariff issues, potentially going to reciprocal tariffs that are at a manageable level, let's say 5 or 10 or 15% country to country. So that's probably the best case, or let's say most products or goods or services come down to that level. So reciprocal tariffs at a low level. That's probably the best case scenario. That's a positive, and then that allows us, the markets, to navigate through in terms of looking at earnings and looking at growth. I think a resetting for the United States of manufacturing in the United States is very positive. It may not be as positive for other nations, depending where the manufacturing is sitting. The US is still by far the largest individual market, and in particular, the largest individual consumer market. So for the US, there are a couple of potentially positive outcomes from the current backdrop.
Okay, great, great. So thank you very much for that, Arun. Last question. If we were to have three considerations that the clients that are listening to today's webinar are kind of wanting to understand that we're looking at in the markets, what are those top three considerations that you think that we as a firm, but also the client should maybe be keeping an eye on to kind of understand where we're heading moving forward?
Yeah, good question. So we're definitely looking at the current tariff situation in terms of how that gets resolved. And we're looking specifically country by country because there are very different impacts or implications for agreements with specific countries. So we're looking at that, and we think there's many, many different ways to allocate the portfolio depending on how some of these decisions are finalized and what some of the end result is. Number two, future growth we really think is coming from a platform, multiple platforms, robotics, AI, blockchain, battery storage, and energy technology. Those are four very significant areas of growth. We think the next set of winners will come from those areas. And that's part of what the US is attempting to reset in terms of how some of those future industries are both set in terms of manufacturing and in terms of the ability to access the US market and the developed markets. And then number three is inflation in terms of controlling inflation, lower energy price, which we have seen. The falling price of oil is a definite positive for lower inflation. That allows the Federal Reserve a little more room to navigate, and lower inflation obviously has been a big goal for the administration as well. Post the inflation we saw in the last 4 years, where we got to 9%, which was the highest inflation the US had since the 1970s. So I think those are 3 areas that we're looking at, some of which overlap and some of which are a little bit independent in terms of how we look at them from a portfolio perspective.
Great. Thank you for that, Arun, and thank you for taking some time today to give us the outlook for 2025 and kind of help us navigate some of those shifts that have gone on in Q1 of this year. Well, and so that's it for today's conversation. Again, if you have any questions for anybody listening to the webinar, please reach out to your advisor, ask them any of those questions on anything that we discussed today, or if there are any general questions for Arun himself. Please email us at info@blackpointcp.com, and we'll get you back any of those questions in a timely manner. Again,
Sure.
thank you very much today.
Great. Thank you. Nice to be with you.